How many of you are undergraduates? How many of you are graduate students? How many of you are faculty? I guess we didn't get any of them. How many of you have started a business? How many of you who started a business is in current operation? Is your business still running, or did you?
It runs on and off
Okay,
based on my schedule.
all right. How many of you aspire to be entrepreneurs? Good. Well, what we're going to talk about today is equity compensation. You are my guinea pigs for this particular format. As it says, the overall volume of slides for all the topics adds up to 60 or 70 slides. And I think we're going to look at 14. So I've sort of skipped a lot of steps wherever there was a build. I've just got the end point. So if you want me to back into and show how the build occurred, I'd be happy to do that. All right. Ask questions. So why should you care? Well, you have to care if you're a founder. When the company starts, you have to divide up the ownership at time equals 0. I will use a C Corp vocabulary. There are a bunch of different legal entities that you could start as an entrepreneur. But if you're going to go down a path of getting institutional money, like from venture capital, you're going to be a C Corp. Maybe not at the beginning, but certainly by the time an institutional investor were to get involved. So I'm going to use that kind of language. So you're going to, for starting your company, getting good legal help through all of the startup time period is not a time to be cheap. If your legal structure or other legal elements of your startup aren't done correctly, it can be a major problem somewhere down the line. So when you start your company, it's going to be time equals 0. You're going to file with the Securities and Exchange Commission, those kind of things. And part of what you do is, okay, there's 100% of this company, and it's going to be distributed among the founders. And then the question is, how do you do that? If you're in your company and you're recruiting people to join your company, stock options are the mechanism that you use to get somebody to leave a very good job with very good compensation to come and join you. And part of the pitch is you're going to make a lot of money by having stock options. If you get recruited by a firm that is venture backed, for example, you want to understand if they make a stock option offer, what does that really mean? If you're an employee, you typically will have stock options as part of your annual review. And finally, stock option pools impact valuation and ownership percentages. That's sort of secondary, but by the same token, it's very important because of the impact it has on your holdings or the people that you attract. So, the founder's pie. When you start, this is what you're looking at. And what you have to do is figure out what are the slices of this founder's pie. Now, in many cases, there's one driving individual who is sort of the visionary, the leader, all of that. And that person is attracted, in this case, three other people to join the startup. But it's obvious that this one person deserves, in Nick says, 50%. There are other situations where there's sort of a natural pecking order in terms of skill set and resources and experience and all of that. And so it sort of works itself out just based upon general agreement of relative contributions. But more often than not, the company is started by taking the number of founders and divide that into 100. And so if there's two, it'll be 50-50, three, a third, a third, a third, four, 25% for each. And part of the justification that's going to be, it's fair. We're all here. We're all going to get in this together. We're all excited about it. And so, dividing it equally seems to be fair. And the reality is, not only might that division be unfair, it could be setting the seeds for the company's demise. I won't go into great detail about it per se, but if you were to move forward and seek institutional investment, the investors want to make sure that the people are being compensated and incented in a way that's commensurate with what they're asked to do. And if there's been a terrible misallocation of those founder shares, it may be such that fixing that is either too costly to do or screws up the entire cap table by trying to reconcile it. And so basically, if those are problems, an investor will basically say, love your company, would like to invest, your cap table is so screwed up, I can't touch it. I'll move on to my next possible deal. So just think about, you got two founders. One jumps in, no income, working 60, 80-hour weeks. And the other founder stays with her job, and she's going to help out at night and weekends. How do you think the one who's jumped into the company is going to feel after 6 months, let's say? Has an equal division been fair? I think not. One of the people wants to take advantage of the ability for a company to lease cars and enable senior executives or the founders to have those lease cars, thereby shifting personal expenses onto the company legally and for tax purposes. Company's doing well. One founder says, I'm happy. I'm making $400,000 a year. It supports my lifestyle. I don't have to stress out about things. All I want is continuation of the 400 and hopefully 450 and 5 and all of that. That's why, as this company has evolved, that's how I have viewed my role and my aspirations for the company. And the other founder says, no, we have the opportunity to change the world. So I want to leave as much money in the company that's possible so that we can fund the development and we can create that company that changes the world. Well, how do you resolve those issues? And the thing is that if you've got two founders, then just imagine the complexity of the inter-founder dialogues or talking to one another. But if there are 4, 5, or 6 founders, the complexity of pairwise interpersonal relationships, multiplied by, an enormous factor. And so that's where things can get really dicey. So what do I propose that you do about it? Well, at the start, you're trying to figure out who should get what. And that is partially a function of who has contributed what to date to get you to a position where you're ready to found a company. And also, what are you expected to provide going into the future? So what if there are 4 founders, who is going to be doing what under one circumstance? Is every founder jumping into the company or only one founder jumping into the company? Who's responsible for doing fundraising? Who's responsible for securing the IP? All of those topics are ones that as a startup business, you need to address. And you should then obviously map them into the people that are supposed to do it. And you want to make sure that when the day is done, the incentives for the people align so that they're complementary to one another. Generally speaking, what we're doing, we're setting up a structure whereby the equity of each of the founders in general will end up basically tracking with the investors aspect. An investor invests $1 today with the hope of getting $10 down the road. So there is part of running a business like this, if you go down to institutional capital, is you have to accept the fact that success, or one level of success, is that you have to take the company to a liquidity event. In some cases, it's called the exit. I choose not to use that because it's an exit for the investors. They're able to get their money back with their return. But the entrepreneur may look at a liquidity event as being acquired by an organization whose independent credibility will be of great value to me as my company moves forward. Access to capital is better. So I've gone from being the leader of an entrepreneurial venture that has done very well, and now by participating within a larger organization, I can step the pedal to the metal and get even bigger because the benefit of being part of that. So the incentive alignment basically is you have to buy into the fact that the liquidity event, whatever it might be, and normally it's an acquisition or an IPO, has to be built into everybody's mindset of what you're about to do. So let's take a look at basically, 5 elements of a business that are important with regard to its outcome. You got to start with an idea. You have to have you have to know what the industry's like. You have to have a Rolodex of contacts. You've got to have experience within the industry that the idea is attempting to enter. You have people that are going to be assigned a variety of tasks or responsibilities. You have a number of people who are going to make varying degrees of commitment to the company and assume a certain amount of risk. And also, you have to be able to map the idea into a business. What is the business? So if we take that, if we're talking about our company, first thing you do is you say, okay, how important are each of those factors today? And for the sake of illustration, we're going to say that this is a spin out from a university. Founder one is the tenured inventor of the technology. Founder two is the business guy. Founder three is the postgrad or postdoc graduate who's working within the technologies lab. And fourth is a lab tech who just sort of happens to be there when all of this is going on. And so when you take a look at this, the idea highly rated as a 7, meaning without proprietary technology that can be the basis of a unique and compelling business, you really don't have a business. So that's pretty important. And in this case, you know, the commitment and risk, particularly with a pure startup, is quite a bit. There probably won't be money at the beginning to pay salaries and those kind of things. So you take a look at those 5 elements. How important are each of them to your particular situation? Now, the follow-on step is, how does each founder rank within each of those elements? And so in this case, again, the founder one is the technologist, the industry luminary, and that his technology or her technology is really the basis of it. So if you take a look at it, founder two, the business guy, in this case, the founder two has made the commitment and risk to join the company full-time, and founder two is the one who has to sort of drive the business on a day-to-day basis. You have founder three and founder four. Founder four has some domain expertise by working in the lab. And so you take a look at that, you put those two concepts together to come up with the weighted value for each, add them all together, and what you end up with here, this is not, you end up with a worksheet that basically calculates how those points have been distributed among the founders and what does that look like. And so when you take a look at this, those numbers are not the numbers. Those numbers are directional. They are illustrative. They are numbers that provide a foundation of discussion among the founders. Yeah, if the faculty member isn't joining the company, does that faculty member really deserve a third of the company when we realize the rest of it? Does a business guy with limited experience probably really deserve 40% of the company? When you look at the technology leader and the business leader, is the relationship between the two of them such that the business leader seems to be superior to the technical leader in terms of just relatively? Similarly, does the postdoc student deserve 17%, et cetera? So these numbers are directional, they're comparative, and they're rarely the numbers that will ultimately be used, but they set the stage for a very powerful conversation. So now you've got the cap table set up for the founders. It's time to move forward. I mentioned before, stock options are important. So let me review briefly. The stock option says I have the right to buy a share of stock at the price of today, and I will be able to sell the stock sometimes in the future if that liquidity event occurs, or if the option is about to expire. And so that, you know, the real purpose of the stock option is this is where the wealth is going to be created. So let's say you had 100,000 stock options at an exercise price of $1 a share. 5 years down the road, the company is acquired at $10 a share. Mechanically, what happens is the stock option owner would buy 100,000 shares for $1 a share, and then would sell those 100,000 shares at $10 a share, yielding a gain of $900,000. So you can add a few decimal places into that example. You can see how the wealth that could be created by virtue of holding the stock options is extremely material. And that is the lore of stock options that you would present to a potential employee of, look, there are a couple of reasons why you want to join my company and abandon your current position, which I understand you're paid very well. I understand you've got incentive compensation that is amazing. I know that you've got, you know, people work on and on and on, but you're just a cog in a bigger machine. If you join me in my company, we will pay you as much as we can, or whatever's prudent at that point in time. But what we're also going to offer you is stock options, which, if we hit our business plan, will mean that you have an opportunity for an 8-digit payout when we hit a liquidity point. And by virtue of joining the company today, you are going to be in the front row seat of helping to create this business. You're not a cog, you're the driver. And that can be a very powerful, you know, incentive for people who want to build something as opposed to being part of somebody else's build. So that's the big deal. Then the question is, how many is enough? And the answer is it depends on the fully diluted share basis of the company. And what that means, fully diluted means the cap table, capitalization table, a spreadsheet that basically says, here are the equity owners. Here's the number of shares each of them have or have a right to. And here are the percentages that each of those have. And the fully diluted will include the entire stock option pool as part of the fully diluted. So it's not limited to just the stock options that have been granted, but it is anticipation that the stock option pool will be granted to employees and it will be absorbed. So therefore, you need to take a look at not just the shares outstanding, but the fully diluted shares of the company. So, for example, if you're offered 1,000 options, that doesn't strike you, doesn't make your heart go pity-pat. But if there are only 100,000 shares of the company, it's 1%. If you have 100,000 options and the company has 10 million shares, you've got the same 1%. So the important thing is that without knowing the fully diluted share base of the company, you can't evaluate the number of options that you are offering or that you are being offered. And so sometimes if this is a first hire for this individual or whatever, it's sort of human nature to say, well, that sort of sounds like a big secret or whatever. I feel embarrassed or whatever to ask for something that is so client confidential or company confidential. And the response is, no, it's the only way you're going to be able to evaluate the offer that you've received. So you need to know that number. And if the company isn't willing to provide that number, that reflects on the company along a couple of dimensions that aren't good. Because the company should recognize the importance of the relationship between the number of stock options, the fully diluted basis of the company. So now we come up with a phrase called vesting. Just out of curiosity, show of hands, how many of you know what vesting is? Okay, a couple of you. All right, so vesting is really what I've called here is now you see it, now you don't. And what that means is you get a grant of options, let's say the 100,000. You're going to earn those options over time. So you've been granted those options, but your ownership of those options are going to happen as time progresses. And the reason is that the company wants to tether you to itself so that you are incented to stick with the company and work through the vesting schedule in order to own the options that have been granted to you. The typical schedule, or let me add a little commentary here. If you remember my comment about the company being acquired, well, if somebody comes to acquire the company in the third year, an acquisition of a company like this is primarily delivered through the people of the company being acquired. It's not the patents, it's not a lot of different things. This is a well-oiled machine that does great technology development and has received great customer feedback. And I don't want all of that company's employees to become instant millionaires and walk out of the door. So part of the reason why the vesting is there is to have a reason why somebody should stick with the company following an acquisition, for example. The typical schedule is going to be 4 years, total 4 years. Typically, it'll be 25% of those options will vest on the first anniversary. And then they will vest at the rate of 1/36th of the balance per month over the next 3 years. So by the end of 4 years, those stock options will be 100% vested. Now, one of the gotchas or things that you need to be aware of is this is, I won't say it's not done, certainly not the intent, but it basically says you're on probation for 364 days because you don't own any of the options until the first anniversary. So from a company perspective, hey, we get to test drive this individual for a year to make sure that they are going to be able to fill their role and make the contributions, blah, blah, blah. And if it's not working out, then what we do is we can part ways, and we haven't put any of our equity into a non-productive area. Okay. This makes sense. One of the other things that you will often hear, at least I often hear, is the whole idea that, when you're talking about this type of a situation, it's you'll hear the phrase, what do you want? A large percentage of a useless company or a worthless company, or a small percent of a large company? What is the better outcome? And in a founder's mind, that's a difficult concept to get your head around, because as you start this, it's your business. You think of it, my business. And if it's my business, then mentally, I own the majority of the stock, or I have the largest share. I have to have a very meaningful ownership position within the company. And for you to tell me that that percentage is going to go down, that doesn't feel right. And so there's a lot of hemming and hawing and gnawing of teeth and all of that. But the reality is, let's take a look. Now, at a very high level, I say this is how it's supposed to work. So the founder starts 100,000 shares, goes through a first round investment, second, third, and then goes public. Okay, so that's sort of the textbook progression of a institutionally backed company. Now, the founder's shares is a fixed number. If I own 100,000 shares when the company is created, I will own that same 100,000 shares going into the future. My shareholdings do not increase as a result of the growth of the company or otherwise. I may have it increase through distributions of stock options, but my founder shares is a fixed number. And stock options are going to be part and parcel of this type of a company. And so when the first Series A investors come on board, they say, gee, we think the company should have a stock option pool that represents 20% of the equity so that can be distributed. And the investors come on board. So here you've got round one, Series A is $1 million at $6 a share. Series B is $5 billion at $11.25 a share. Series C, 10 million with an increase of the price to 21.9. So if you look at that, you've got the progression of the amount of money that's going into the business and the share price are both increasing, which is a good thing. And then when the company goes public, it sells 20% of its equity to go public. That raises a certain amount of money. But getting back to the topic, look at the progression of the founder's ownership. 100, 30, 11 and a quarter, 7 and a quarter, 5.81. So that's a smaller piece of a larger pie. And what does that mean? It means that the value of your shares that you own today, before the first round investment, who knows what they're worth? Under those circumstances, they may not be worth anything in reality. But here we've got a situation where over the course of those investments, the equity ownership has dropped to 5.81%, but the value of that equity is $11 million. And so as you look at that, is that consistent with what your desires are, your expectations? Does that make sense to you? And, for some people, no, I want to make at least $25 billion. Or for other people, holy hell, gee, I was hoping to be a millionaire, but not a cent of a billion or whatever it would be. And so the idea that you are going to be selling equity in your business over time is part of the process by which companies grow. And so every time that you acquire an investor, that investor is going to be buying new shares of stock. So the total stock holdings, the fully diluted cap table, is going to be increasing in number. Founder position is a fixed number of shares. So arithmetically, it's got to go down. It's just arithmetic. So, hey, I did such good editing on my presentation. We got done. So you need to think about how you're going to distribute the equity over time. And you can forecast it. If you were to take, say, that small piece of a bigger pie and take a look at, how many shares are going to be in the option pool, and at that point in time, how many of them do you think will be distributed? And so you go through sort of the iterative process of, okay, we're going to have to bring on this, this, and this. Those are people that are going to command 3% of the company at that moment in time, and So you need to budget it out so that you can make sense of the stock option pool, its adequacy, and its impact. Because obviously, that's my verbal pause. Because when you add stock options, you're increasing the fully diluted number of shares. And the value of a company is a function of the company's most recent share price times the number of outstanding shares, or the number of shares on a fully diluted basis. And so the act of increasing a stock option pool also increases the value of the company on an arithmetic basis. So it's something that you need to understand so that as you see the shiftings of the percentages, you can understand that they're proportional, they're happening in the right direction under the set of circumstances of value and everything else. This all makes a lot of sense. Starting a company is very challenging. If you are going down a path of institutional investment or plan to, the institutional investors, venture capitalists, that's their job. They look at companies, they value companies, they negotiate deals. on a daily basis. So they know what a certain parenthetical phrase in a term sheet may or may not need. There may be twists and turns with regard to something like a liquidation preference. Well, as a first-time entrepreneur or even second or third, because some of the more mundane things, they're important, but they're also things that slip out of your memory almost immediately. You are not playing on a level playing field. And so what you have to do is, number one, make sure that you have good professionals that are advising you. As I said at the opening, this is not the time to be cheap. Now, you may be able to barter, say, stock options with a good law firm. You may be able to cobble together, a down payment or a partial payment but make sure you're using experienced professional deal lawyers so that what gets set up is correct and doesn't implode when an investor comes along and you run those numbers. If you haven't already done so, first thing you do when you leave today, go identify 10 people that you think it would be beneficial that you knew, that you don't know yet, and figure out how you can bring them into your circle of mentors and advisors. I often will point out, if you can identify the CEO of a company that is similar to you with regards to the industry, similar to you with regards to the scale of the resultant company and where it started, if you can get that CEO to be a mentor, that CEO has been through the 18 months that you're just starting to enter. And that CEO has all the battle scars that you may have the opportunity to adopt yourself. And that CEO will recognize that she only got to where she was because she had advisors and mentors. And therefore, part of the lore of entrepreneurship is it's your responsibility to provide that type of mentoring and feedback to the next round of entrepreneurs. And so if you can identify several people of that profile, that then gives you a very rich human resource bank. If they've already raised institutional money, which would be helpful, then they can be gateways to investors. And so there are all these reasons why getting industry experienced founders, at the least CEOs, better, is make sure you do that because they have felt the pain of getting to where they are. They will want to help you avoid perhaps their most damaging gotcha along the way. Make sure you have good professionals. It's critical. And therefore, I have successfully taken a 3-hour presentation and reduced it to 45 minutes. It also means there's a lot of layers of things under here. So as you get the deck from Allison, walk through it all. If you give them the unabridged version, because I got as I told you, there are tons of hidden slides in here. Any questions?
Hi, good afternoon.
This is important. Some of what I had to say is very important. And it's important for you to realize that. Yeah.
Can you hear me?
Question about what's your approach when you do identify someone as a potential advisor, mentor? How do you what's your first step in engaging with them? Like, what's your mind frame?
If you can find a warm introduction, somebody that you know who knows that person, and if you're talking about within the same industry, there probably is a common denominator, you might do that. Otherwise, you might just do a frontal assault. I'm a beginning CEO, and you're a successful, well-honed CEO, and I would really love to seek advice and counsel from you as I go down the path that you have already. And normally, the CEO to CEO kind of outreach works in most cases. And by doing that, you've now elevated that the recipient's view of who you are and why they are. And you're not just, once you want to graduate with working on a term paper or something. You're a business person who's looking for physical life. So, if all else fails, the frontal assault was the best.
Yeah. Why not?
There really isn't it. Other questions?
There's one online. Maybe turn it up.
Okay.
Michael, if you want to talk.
Hi. Yeah, thank you so much for the talk, Frank. I was just hoping maybe you could go through like a couple examples of like how liquidity preferences, preferred stock, common stock, and options for startup employees all kind of mingle together for, the valuation of those vested securities at a liquidity event.
Yeah. Well, first of all, I'm going to partially punt because those go well beyond just equity compensation. Those are really essential elements of doing a deal. So let's break it down a little bit. When an investor investing, they're going to invest, as I said at the opening, with the anticipation that if they invest $1 today, they're going to get $10 back down the road. Well, the success rate of venture-backed companies is not particularly sterling. You take high risks with high-risk companies, they do well, you have a great return. And if they don't, then in many cases, what you will seek to do is to get the company acquired on some basis. And so what liquidation preference is I am buying preferred stock, which is part and parcel of the C Corp mindset. So the institutional investor buys preferred stock. One of the preferences of preferred stock is I get my money out first. So if we have to sell the company at something less or much less than the home run that we wanted, the first X dollars that get distributed come to me as the investor. And so at those first dollars, normally it will be the investment amount plus accrued but unpaid dividends. Sometimes, depending upon a whole slew of things, it could be a multiple of that. So it could be 1.25 times, 2 times. Because anywhere above 2, it means you're in a world of hurt, and this investor is only willing to take the risk if they can get that level of a multiple. So the liquidation preference is if you have to sell the company for something less than a home run, for example, you get it out. At the risk of over confusing you, but since I always find it sort of interesting, within preferred stock, there is a flavor of preferred stock called participating preferred. Now, when you're talking about participating preferred, that sounds nice. We're going to collaborate. We're going to participate. participating preferred is not good for the entrepreneur. Participating preferred says, not only do I get my liquidation preference, but once I've received that, I share in the balance on a as converted basis. Some people call that double dipping. So not only do I get my investment in that core return, but I also get something extra. And entrepreneurs can object to that strenuously. Sometimes whether it's participating or not is almost market driven. If the market is tough in raising money, then the possibility of the investors being able to take advantage of those circumstances and get participating preferred may occur. So, quick example. You invest $5 billion in a company for 50%. And 2 years down the road, the company has not succeeded. And we sell the company for $10 million. So you think about that, and let's see, the founder owns 50%, the investors own 50%. Okay, I'm going to get $5 million out of the deal. It's not the home run that I wanted, but it's not an insignificant number. And the investor will say, time out. I will get my liquidation preference out first. That's the $5 million. And then I will take my pro rata share of the balance. And so there's $5 million left. I get $2.5 million. So if we end up selling a company for $10 million, the investor's going to get $7.5 million, and the founder's only going to get 2.5. So those are the types of things that can happen under those circumstances. Anything else?
Hi. I also have a question in Zoom.
Go ahead.
Hi Frank.
Hello?
Can you hear me?
What are we doing here?
They asked the question. We can hear you.
All right, thank you. Thank you so much for the talk, Frank. And I come from a non-tech background, and it might be silly. So if we started with two co-founders and each of us had, like, for example, 50-50% of the share, and then when like a third co-founder joins, like, are we taking out like an absolute amount of shares from both of like our stocks, or like are we like issuing new stocks, but like so like the absolute value of the our stock remain unchanged, but it's only like the percentage of the share of the original two co-founders got dropped?
Quick answer is any stock that is shared with an individual, either stock options or restricted stock, is new shares, as is any investment. So an investor will buy, 100,000 shares of preferred stock, and its conversion into common stock is on a 1-to-1 basis. And if you bring somebody on board, now a gotcha or a thing to consider is the sequence that you just discussed. If that individual were not a true founder in terms of being there at T=0, do they deserve to be designated as founders? And the reason I mention that is my experience is that founder functional leaders, like say the VP of business development, If the founder is the VP of Business Development, the founder might receive 15% of the company. If it's somebody, alternatively, if it were somebody that was being hired, that person would likely get 5% of the company. So being a founder has a 3x impact on the percent ownership of somebody in that. And so an ongoing question is, should a person be considered a founder, particularly if it's well after the founding of the company? My rule of thumb is, as you look at this individual, can you hire someone with a similar skill set and experience? Is this person equivalent to a hire, or does this person have unique assets that can be brought to the company that warrant consideration as a founder?
Thank you. Thank you so much for that. And I had another question. You mentioned earlier in previous slides, there are like certain like stock shares, like dividends that will let the investor see as like deal breakers or like unfavored like relationship in the company. Is there any like recommended structures that you would like do for a 2 or 3 person team?
One more time.
So you said earlier there are some like ways to divide the share that are like deal breakers for the investors, for example, like
Yeah,
50-50. So is there like any recommended way of doing like for example like 60-40 or
yeah. Do what I said in this presentation rather than dividing everything equally, and you'll be in much better shape.
all right.
And I don't mean to be as flippant as I was, but yeah, if you've got 2 or 3 people, it's going to be a challenge. One of the things that I point out is if you were to use the founder pie calculator, as I've called it, and you could do this one of 2 ways. If you get all the founders together and begin to fill in each of the boxes collectively, you could look at that founder matrix as really each cell is a topic of conversation. It's an agenda of, okay, you're the inventor. How much of the pie do you think you deserve, or whatever? You know, when you first start those discussions, if you're a first-time entrepreneur, the faculty member is a first-time entrepreneur as well. The faculty member highly likely will say, look, there is no company without my technology. Therefore, I deserve 80%. Well, I don't think the other founders are going to find that to be a particularly useful insight. But if you don't get those issues out and resolved, they're just ticking time bombs that are going to kill you somewhere down the road. And people will say, well, gee, I don't want to get into personal issues and all of that. If you don't want to get into them today, where everybody is presumably rational and sort of understands the logic of everything that's happening, what do you think it's going to look like in 9 months when nobody is rational, everybody is emotional? The people that jumped into the business are feeling that they got royally screwed, and they actually deserve, multiples of what they've already gotten. So to play ostrich is put your head in the sand saying, oh, well, we'll talk about it later because we all we get along fine. No, talk about it today, because it will unearth where expectations are aligned or not. And you'll have a chance of identifying what are the areas of greatest contention and can they be resolved. And it's much better to have that discussion today than 9 months down the road. So that's part of my suggestion.
Thank you.
You're welcome. Well, we done?
Yeah, unless you guys have any other questions.
Okay, well, Allison will share with you the presentation. You either have or will have my email information. You have questions, send them my way. My standard request of those type of things. Put all caps in the subject line, and I'll know it's coming from somebody at CMU. Because I get, like all of us, I get flooded with emails, and triaging them can be a challenge. So if I see all caps, I'm going to assume that it's a student, and I will take a look at it sooner rather than later. Okay?
Okay.
Thank you.